Hi, I'm Trevor Austin, founder of Authentic Life Financial Planning. In this video, we're covering how RSUs can trigger a higher tax bill and what you can do to avoid it. Another tax issue that I see with RSUs is on the amount of withholding that is being done at vest. And so the issue kind of comes up with, what I've already talked about, where companies generally will withhold at supplemental wage rates, which currently is 22% for Fed or 37% for Fed, depending on how much income you expect in the year. Now, some companies will allow you to adjust that. Not all do. I'd say most don't at this point. The exceptions to that is most of the FANG companies, so Google, Facebook, Apple, Amazon, Netflix, most of them will allow you to adjust the withholding. The other period where I've seen it happen is with companies who are going through a liquidity event, whether it's an IPO or a merger or acquisition. They'll generally allow you to adjust the withholding to kind of meet what is the right withholding for you. Outside of that, though, it's pretty rare. And the reason why that is an issue is that withholding rate may not be the right withholding rate for you. Could mean that you're withholding way more than you need to, or it could mean that you're withholding way less, which is usually the actual issue I see, is that the company is withholding way less than what you need, which means come April, when you file your taxes, you may end up having a pretty significant tax due that you were not expecting. The bigger reason that becomes an issue, in my opinion, is because if you have not sold your company stock and were planning to sell your company stock to kind of cover that tax burden, you may have to sell at a time that you're not happy to be selling your company stock. And so it can be a really big issue, especially for people who have a pretty significant amount of their income coming in through RSUs or RSAs. That can be just a really big problem, where you're owing, again, thousands to tens of thousands of dollars in federal and state taxes that you were not planning to. And then you have to come up with money somehow, some way, and that may include having to sell your stock, again, at a price that you don't want to. So there's kind of three ways to fix that. I already talked pretty in depth about the one that you may be able to be allowed to adjust the standard withholding that your company does. Again, there's no guarantee of that. Again, it's probably more rare for that to be an option than for it to exist, but it is a good option if your company allows it. Outside of that, there's really only two other options. Well, I guess there's a fourth, and I'll cover it and why I didn't include it here. But there's two that I think is a good option. So the first is paying quarterly estimated payments. So if your company doesn't allow you to adjust the federal withholding or the state withholding on RSUs, the next best option really is paying quarterly estimated payments. Essentially what that means is that you have to run a tax projection. Either you or your CPA or your financial advisor have to run a tax projection, and they'll kind of tell you what you should be paying throughout the 4 quarters of the year. Now, that's in general is a good option. The only problem is that you have to kind of make sure you're withholding enough and you're taking those steps to actually make that payment, the 4 times throughout the year. But it is something to just be aware of, that it exists. It's an option. And again, it's probably one of the better options, but it is quite manual to do. The second option that I'm suggesting is just selling additional shares at vest, and then you can either adjust your page stub withholding, or you again have to pay quarterly estimated payments. I'm kind of a big believer that your company stock awards should pay for the tax that they have incurred. And if they're not withholding it the right way, if they're not withholding enough, then we really should be selling some shares to pay the tax now when the shares vest, rather than, again, hoping in April it's at a good price that you're happy to be selling at. Because the likelihood of that happening is pretty low. So we have to kind of plan for that to not be the case. And yeah, basically just have to plan to sell the shares when they vest and have the cash available for, again, either quarterly estimated payments, or adjusting your other withholding for your salary, bonus, other things to be able to cover the withholding. Now, the last one I've already mentioned is that you can always adjust your withholding on your cash payments, your cash compensation. So again, salary, bonus, commissions, things like that. The reason I don't love that goes back to what I said earlier, where I really am a believer that your stock awards should be paying their fair share of the tax. And by adjusting your cash compensation to cover the tax, you're essentially making the decision to buy more of your company stock and reduce the amount of spending you can do, reduce the amount of diversified savings that you can do. And that just doesn't feel like a good plan to me. We'll talk about kind of my philosophy on how much stock you should be holding. But one thing that definitely gives me pause is, just blindly putting more money into your company stock. Because again, your cash compensation already tied to your company performance. Your stock awards, your RSUs, already tied to your company performance. Any shares that have already vested that you've decided to continue to hold, that obviously tied to your company stock, right? So we need to be careful with how much we're kind of relying on your company stock to do well going forward. Thanks for watching. If you found this video helpful, please like, subscribe, and drop a comment below with any questions or topics that you would like to see covered. Financial planning is all about creating the life you want. Let's build it together.